In the realm of finance and accounting, the cash flow statement holds a prominent position as a vital financial statement. It serves as a powerful tool that unveils the intricate details of a company's cash inflows and outflows over a specific period. By dissecting the mechanics behind cash movement, the cash flow statement provides invaluable insights into the financial health and operational efficiency of a business. Unlock the secret to financial success with Counting Coins, where numbers come alive and your accounting game thrives. In this video, we will explore the significance of a cash flow statement, its purpose, structure, and the methodologies employed to prepare it. By the end, you will gain a solid understanding of this essential financial statement, empowering you to navigate the complex world of corporate finance with confidence and clarity. The cash flow statement is a vital financial statement that provides a summary of a business's cash inflows and outflows over a specific period. It's an essential tool for understanding how cash moves in and out of a company. But before we get into the nitty-gritty details, let's take a step back and explore why the cash flow statement is necessary in the first place. In the world of accounting, there are two primary methods for recording financial transactions: the cash method and the accrual method. The cash method recognizes revenue when cash is received and records expenses when cash is paid out. On the other hand, the accrual method recognizes revenue when it is earned and records expenses as they are incurred, regardless of when cash exchanges hands. If a business follows the cash method, its income statement summarizes revenues and expenses over a specific period, ultimately resulting in either a profit or a loss. However, since revenue is recognized only when cash is received and expenses are recorded when cash is paid out, the income statement prepared under the cash method is equivalent to a cash flow statement. Many small businesses prefer the cash method for its simplicity, and it's perfectly acceptable for them to use it. However, it's crucial to note that the cash method is not allowed under the International Financial Reporting Standards, or IFRS, or the Generally Accepted Accounting Principles, or GAAP. If a company follows these accounting standards, it must use the accrual method. Under the accrual method, revenue is recognized when it's earned, and expenses are recorded as they are incurred. In accrual accounting, the income statement showcases a business's earnings and expenses, not its cash inflows and outflows. Consequently, businesses using the accrual method maintain a separate cash flow statement alongside their income statement. Additionally, they also have a balance sheet, which presents their assets, liabilities, and equity. Now that we have a solid understanding of why we need a cash flow statement, let's delve into its structure and purpose. The cash flow statement provides insights into a company's cash inflows and outflows over a specific period. It begins with the opening cash balance at the start of the period and compares it to the closing cash balance at the end of the period. These numbers can be found in the balance sheet. The difference between the opening and closing cash balances represents the net increase or decrease in cash. The cash flow statement is typically divided into three main sections: cash flow from operating activities, cash flow from investing activities, and cash flow from financing activities. 1. Cash flow from operating activities. This section focuses on the cash flows generated from a company's primary revenue-generating activities. It includes cash inflows from selling goods or services and cash outflows from operating expenses, such as payments to suppliers and employees. Essentially, it represents the day-to-day cash movements related to a company's core operations. 2. Cash flow from investing activities. Investing activities involve the buying or selling of long-term assets, such as investments, property, plant, and equipment. Cash outflows occur when a company purchases these assets, while cash inflows happen when it sells them. Investing activities reflect the cash movements associated with the company's investments in its future growth. 3. Cash flow from financing activities. Financing activities focus on how a company raises or repays funds to support its operations. Cash inflows in this section typically come from sources such as loans, issuing stocks, or other forms of equity financing. On the other hand, cash outflows may result from debt repayments, dividend payments, or stock repurchases. Financing activities provide insights into a company's capital structure and its interactions with lenders and shareholders. Within each section, positive numbers indicate cash inflows, while negative numbers represent cash outflows. By analyzing the cash flow statement, stakeholders can gain a comprehensive understanding of how a company generates and utilizes its cash. If you've liked the video so far, please give it a like, subscribe, and let us know in the comments what you would like us to cover next. Now back to the video. Now that we have a solid grasp of the cash flow statement structure and purpose, let's explore the two methods used to create a detailed cash flow statement: the direct method and the indirect method. The direct method focuses on cash flow from operating activities and mirrors the income statement prepared under the cash method. It begins with cash receipts from customers, representing revenue, and deducts cash paid out to suppliers, employees, and other expenses. Cash flow from investing activities involves cash outflows from purchasing investments or long-term assets, and cash inflows from selling them. Cash flow from financing activities relates to the raising or repaying of cash through liabilities, such as bank loans, or equity, such as issuing stocks or paying dividends. By adding up the net cash flows from operating, investing, and financing activities, we can reconcile the net increase or decrease in cash back to the movement in the balance sheet. The indirect method, on the other hand, focuses on cash flow from operating activities and involves three steps. First, we start with the net profit or loss obtained from the income statement. Then, we add back non-cash expenses such as depreciation, amortization, and any gains or losses on the sale of non-current assets. These non-cash expenses do not involve actual cash flows and need to be reversed out. Finally, we adjust for the movement in working capital, which refers to the changes in the company's current assets and current liabilities. Increases in current assets like inventory or receivables reduce cash flow, while increases in current liabilities like payables increase cash flow. By following these steps and referring to the income statement and balance sheet, we can determine the cash flow from operating activities. While the direct method may be easier to read, it can be more challenging for accountants to prepare. Conversely, the indirect method is simpler since many of the required numbers can be found in the income statement and balance sheet. Now let's dive into an example to see how a cash flow statement is prepared using the indirect method. We'll consider a fictional dating app called SoulSwipe and examine their income statement, balance sheet, and comparative balance sheet for the year ended December 31st. We'll also take into account various key facts such as the sale of furniture, purchase of computer equipment, debt and equity transactions, and dividend payments. The primary objective of the cash flow statement is to reconcile the movement in cash. To begin, we analyze SoulSwipe's comparative balance sheet, which reveals that their cash increased from $13,895,000 at the end of the previous year to $17 million at the end of the current year. This represents a net increase in cash of $3,105,000. To determine the cash flow from operating activities, we start with SoulSwipe's net profit of $9,650,000 obtained from the income statement. Then, we reverse out the non-cash expenses, such as depreciation and the loss on the sale of furniture. These non-cash expenses appear above the bottom line on the income statement. By adding them back, we adjust the cash flow from operating activities accordingly. Next, we adjust for the movement in SoulSwipe's working capital. Working capital represents the difference between a company's current assets and current liabilities. We consider changes in receivables, such as accounts receivable and other receivables, and payables, including accounts payable, taxes payable, and accrued expenses, from the comparative balance sheet. Increases in receivables reduce cash flow, while decreases in payables increase cash flow. By accounting for these adjustments, we refine the cash flow from operating activities. Moving on to cash flow from investing activities, we examine SoulSwipe's key facts, which indicate a cash flow of $910,000 for the purchase of computer equipment and a cash inflow of $10,000 from the sale of furniture. These transactions impact the cash flow from investing activities. Finally, we analyze cash flow from financing activities, which involves cash inflows and outflows related to funding the business. SoulSwipe raised $100,000 in cash from long-term debt, issued $50,000 in common stock, representing a capital contribution, and paid out $1 million in dividends. These transactions affect the cash flow from financing activities. By summing up the cash flows from operating activities, investing activities, and financing activities, we arrive at the net increase in cash of $3,105,000. This reconciles perfectly with the observed change in cash in the balance sheet. And there you have it. I hope this comprehensive explanation has provided you with a deeper understanding of the cash flow statement. Don't forget to comment below with your thoughts, questions, and accounting victories. And make sure to hit that subscribe button and turn on notifications so I'll see you in the next episode of Counting Coins. Happy accounting!